And just before I begin, I do want to say well done to the Wild Digital team. Thank you so much for putting this together. It's really great to be able to connect with such like-minded and tech-focused people. My name is Belinda Chiu. I am the Business Development Manager here at Australian Securities Exchange, coming to you live from Sydney, Australia. I am joined by my wonderful panelists, David Kells, Ed Clarke, and Shaun Gregorio. So hi, guys. It's great to have you here on today's panel, where we will be talking about funding for technology companies, and in particular, once you're done your B series and thinking about the later stage funding, that ASX can truly be a viable option to fund that next stage of accelerated growth. A couple of housekeeping things before I do get started though. This is a 20-minute panel discussion. We do have open Q&A, which I will be monitoring. If we don't get to you during Q&A, don't fret. We will definitely touch base with you after the session. So let's get started with some introductions from our panelists. Ed, I'd love to hear from you first. Can you tell us a little bit about yourself and about Yojee?
Thanks, Belinda. So yeah, my name's Ed Clarke, founder, managing director of Yojee. Yojee is really a 5-year-old business. We've been very focused at supply chain solutions, technology-based, out of Southeast Asia, more focused a bit in Australia, but really we're building solutions that are now starting to be utilised globally. So we listed about 4 years ago. We've had a really interesting and probably a good experience with the ASX, but our team now is about 50 people. And yeah, we're working with some of the biggest logistics companies in the world across the region and around other parts of the world as well. So it's an exciting time for us. I think it's been interesting in COVID, the pickup of all of the last mile solutions and everything else, which are really coming across from the growth of e-commerce. So yeah, interesting space, and thanks for having me on.
Awesome. Shaun, some introductory words from you?
Hey, Belinda. Hey, everyone. I'm the co-founder and CEO of Frontier Digital Ventures. So we invest and operate online marketplaces. So think of iProperty and CarList in Malaysia, or REA and Domain and the like in Australia. But we invest in those types of businesses in emerging markets around the world. We've currently got 15 businesses that span 20 countries. We focus on LATAM markets, developing Asia and parts of MENA. Our model is quite straightforward. We like property marketplaces and automotive marketplaces. We invest in entrepreneur founder-led businesses and then help them grow the business. And then over time, we like to buy those businesses and operate them ourselves. So we started back in 2014, myself with my co-founders, Luke and Patrick, and we listed on the ASX in 2016. Recently did a rather large placement, which is, I guess, a feature of the ASX, which I think we'll touch on later.
Definitely. Thanks, Shaun. And David Kells from Morgans. Hey.
Yeah, thanks, Belinda. Thanks for having me on. Yeah, so my background is helping companies raise the money. So I've been working in mergers and acquisitions and capital markets for over 15 years. Morgans is one of Australia's largest wealth management and advisory firms. So we have over 500 advisors around the country looking after about $60 billion worth of funds on behalf of their clients. And we're very active working with growth companies listing on the ASX and raising growth capital.
Awesome. Thanks, guys. It's good to have you here, and let's get started, shall we? So as Aussies, David, I do want to start with you. Australia has gone through a very immense evolution of its tech sector over the past 5 years, and I want to touch on that. What are your thoughts on the Australian technology sector, but in particular, the evolution of the Australian listed technology sector?
Yeah, it's definitely come a long way in the last 5 years, but I think there's still a lot more to do. So, by way of example, out of 5 IPOs that we're working on at the moment, 4 of them would be technology or tech-enabled businesses. So it's definitely come a long way. There's a lot better understanding in the Australian market of, how to value technology businesses and software businesses. People are used to talking about, all those sort of key metrics and rules of 40 and all that good fun stuff. So the understanding of technology businesses has developed quite a lot, there's definitely a lot of appetite both in the institutional market and also in the private wealth or private investor market in investing in technology stocks. But as I say, there's still a lot to do. We're still very underweight, I would say, in technology versus, you know, financials and resources. But there's certainly a lot of activity in that sector.
And Shaun, I just want to sort of pick your brain. Do you sort of see the same sort of trends happening with the Australian technology sector, that it's growing, it still needs a lot to go, or do you think it's still quite young? What's your observations on that end?
Yeah, it's interesting. If you go back a number of years ago, it was extremely difficult being a startup in Australia and trying to get funding. The VC environment was really conservative. You had a lot of small institutional investors that were safely investing in larger companies or in financials or resources, as you mentioned. So for tech companies, it was really difficult. You know, our story is that we ended up funding the business ourselves, and probably went to an IPO sooner than we might have had we been in an ecosystem that had a more evolved VC network, for example. So our journey is probably quite symptomatic of many, where, you know, we've found that funding the business ourselves, getting some early sort of believers investing in the business, and then probably leapfrogging what would have been like a VC round or environment, and really tapping the public markets. So I think in the last few years, I'd absolutely agree that has accelerated, and I think early stage tech companies have found an IPO or the public markets actually a pretty viable path to raising capital, versus necessarily, you know, jumping in and getting into the VC world. And to do that, even if you want to get into the VC world, you've probably got to go offshore outside of Australia to really tap a large VC market. So interesting set of circumstances, a lot of fantastic early stage Australian tech companies that are just crying for funding, and have found themselves, you know, going to early stage investors who are familiar with them or the model, or perhaps, you know, going straight to the public markets. And I think the ASX has positioned itself relatively well to cater to that. I think if you ask anyone, I'd be interested in Ed's view that, you know, getting access to the ASX was actually, I won't say it wasn't that hard, it wasn't easy, but it was very doable for early stage tech companies.
Yeah, and I definitely want to ask you, Ed, the same question, the evolution of the tech sector in Australia.
Yeah, look, I think for me, it's kind of a blend of the two responses. David is spot on that, you know, it's still quite tech-like on the ASX, and I think, but there's a big appetite for it, as David sort of mentioned, in the IPOs he's working on. And there's no risk historically of high-risk investments on the ASX or in Australia, but it was always kind of resource-heavy. And I think people predominantly were looking at resources for their big multiples investments. And I think certainly over the last 5 years, people have started to believe that there's probably much less risk and a good chance of those multiples if you invest in the right technologies. And they have started to learn on those metrics and understand tech in a far better way, and realise that it should be a bigger part of your portfolio. So, you know, we're speaking, one of the funds that just helped us with our placement has now reset their business. They didn't even have a tech sector in their analysis and reporting sector. It would come under industrials. We were under industrials. Now it's moved into a tech section. They've done a big reshuffle. So everyone's saying that you do have to have technology, and it's not just for the investment returns. I think it's really important to attract the right retail investors and funds into your funds to show that you do have that capability. So I've seen a really, really big transition. I think that's partly due to the interest and growth of the sector, but also due to some really good champions on the ASX, you know, Afterpay and WiseTech and these types of companies. When people see success stories, it makes them a lot more confident. And I think that's really helped as well when you have really, you know, high profile, big success stories of $10 billion plus companies coming out of the Australian Stock Exchange, which certainly there weren't when we started. So that's been a big, big help.
Yeah, no, that's definitely sort of the trend that we are seeing as well. David, I want to sort of draw from your corporate advisory sort of brain and your experience. We talked about a little bit about VCs and PE. Can you sort of take us through what other options there are for a tech company looking to fund the next stage of growth after the B round funding round?
Yeah, look, I think it boils down into either private funding or public funding, right? So, you know, the private market, VC, PE, and public, you know, listing on an exchange, as has already been discussed a little bit in the Australian market. in particular, the private market is not as well developed, and so the listed market has stepped into that funding role for those growth companies. There's development of institutional investors in Australia establishing investment products to also help fill that gap in terms of pre-IPO funding. So, providing capital to a company 6 or 12 or 18 months out from a listing to help accelerate that growth into a listing event. But yeah, I mean, it's, I think part of the reason that companies end up listing earlier in Australia, as the guys have mentioned, is one, just that the lack of depth of funding in the private market, but also on a comparative basis. I think if you look at the types of instruments that are used, or the terms and conditions that go around the private versus the public funding is relatively friendly. So there's no preferences, there's no ratchets, there's no hooks in there that if something goes wrong, that control can be taken away from a founder, etc. So it's a lot cleaner sort of form of capital as well, which I think has also helped in that people on that journey will get them to look at going listing sooner than you might in other markets.
Yeah. So Shaun, David did mention about sort of the private term sheets, and when Frontier Digital was considering its listing, and it eventually listed on ASX in 2016, what was sort of thinking behind going down the IPO pathway as opposed to staying private for you particularly?
Look, we'd come from listed companies, so we'd sold a listed company, iProperty, to REA Group. I'd worked in the REA through that. So our heritage, I guess, was always in listed companies, and consequently, we'd cultivated a decent enough group of investors that were quite supportive of what we were doing. And many said, look, when you go do the next thing, let us know. But they were all very public market focused. So, I was just sort of sitting here thinking, if we were in the US or somewhere else, we probably wouldn't even think about listing until we were our size now or bigger. Now, we would never have got to our size now or bigger had we not listed 4 years ago on the ASX. So I guess it's a combination of opportunity where, as I mentioned, you can do it, but also I think we kind of have to do it because a combination of the private markets being undeveloped, VC funds in Australia, probably looking offshore anyway. So you're caught in this interesting little crosshairs, and then you think, well, the public markets were quite accessible. At the same time, we had a lot of investors saying to us that we like what you're doing. We'd rather it were publicly listed and we could invest in it, with a different fund or to a greater extent or with more certainty. And, the fact we were able to do a $100 million capital raise just a couple of weeks ago, frankly, if I tried to do that in the private markets, it'd take a year or more. It would be really arduous. And, we're a combination for us of our heritage, our background, I guess the following that we've developed. At the same time, we wanted capital. We wanted it within a defined time period. And I think that's a real difference as well. If you go out to the private markets and you're trying to raise, you ask anyone who's done it, you go out there and say, well, we're starting this process on the 1st of June. It's going to finish on the 31st of August, let's say. It never finishes on the 31st of August. It always goes longer. There are no set times. No one respects the process. And you end up in permanent cap raise mode. And I think the danger for a lot of early stage businesses is that they end up being in the business of raising money. And we didn't want to do that. So for us, part of the appeal of the ASX is it had a start, in theory, a start on a stop date. It had a defined time period. We could manage that and then get on with running the business. So for us, combination of our background, of our size, the industry we were in, and the benefit of having a defined process where we could list, raise the money, and then get on with life, rather than being in this perpetual cycle of forever trying to raise. So, yeah, I think we were lucky in that we had a few factors going for us, and at the same time, that the idea of the ASX was a good fit versus private in my mind, in my experience as well.
Ed, your company Yojee listed quite early on. Can you take us through that experience in terms of you going through the IPO pathway? Was it similar to Shaun's experience?
I think I agree with everything that Shaun has said in terms of why you would do it and why it is helpful. I just think that for the big learning, and obviously I didn't have that learning when I was beginning the process, but there's to come into the ASX, you have to have, as Shaun mentioned, you have to have a clear DNA of your business, right? You have to understand what you're going to execute on and your metrics that you're going to share with people. Because, as David mentioned, there's lots of deals happening. The public market advisors and institutions are not spending as much time as the VCs on the business. So they really have to understand in sort of maybe a series of 45-minute meetings about your business, how to measure you, what are the key metrics to look for in growth. And those can't change every 2 months or every 6 months. You have to say, this is what we're doing, this is the metrics that we're going to achieve against, and this is where we've come from. If you have that DNA, I think you can be really successful. And then all you need around that, if you're a young founder, like I was, and hope I still am in that bracket, but if you're at that, you need a good board. And so you need people that can give you the advice on how to navigate the journey, because there is, in the nature of the market, it changes every day. So there's lots of noise. So if you have the clear metrics and you have a board to shelter you from the noise, and I think Shaun will tell you, he's had a lot of calls in the middle of the day, in the middle of the night, people asking questions and things. You have to stay really focused on your business and not get swayed by people that are calling you from time to time. And so that comes down to a really good board that shelters the young founder and lets him execute. And the business DNA being clear. I think they're the really two key things that you learn are the most important. You can't control the market and the share price. You look at our share history, it's wild. I think Frontier's had the same type of experience. You just can't worry about it. It always corrects itself in time if you just keep focusing on executing. So I think that's the key thing, that when you come to market, you've got a clear focus on what you're trying to achieve and you don't stray too much from that, because that's when you really build value in the business and people can understand and value your business. Because I think the public market investors are really good at understanding future potential value and will appreciate it and pay for it if you can show that you're in that direction, as opposed to VCs, which will be very firm on, well, this is where you are today. And, you can draw your hockey stick and they'll ask for a hockey stick, but they really won't give you much value for the hockey stick that you've drawn. So
all of that totally makes sense to me. So thank you so much for that. David, I haven't picked on you yet. Last couple of questions. From a technical standpoint, what's your view on what's needed to list successfully now as a tech company, particularly if they're coming out of Southeast Asia?
Yeah, sure. So there's obviously a few boxes that you need to tick. So to satisfy the regulators that your company that should be listed, you need to have audited historical accounts. So 2.5 to 3 years worth of audited financials. I think Ed mentioned the board. Having a high quality board, having people either on the board or around the company, company secretary, CFO, or somebody on the board who's got that ASX experience, whilst it's not mandated, obviously from a foreign company point of view, both from internal sort of sanity of the founder, having somebody around who can help navigate through those listed markets, but also for incoming investors, just to have that confidence that the company is going to talk to them, how they like to be talked to and communicated with. So then other things would be scale of operations. So for me, my personal view is that if you're a foreign company having a listing market capitalisation somewhere in the order of 150 million and above is probably a good benchmark to think of. You can list at lower market capitalisation than that, but I think the reasons I use that as a benchmark is twofold. One is that it's a sort of sweet spot in the small cap market for institutional investors, so you'll have a broad range of institutional investors to talk to at that market cap, and also you can also get included in indices such as the All Ordinaries Index or the All Tech Index, which is a good benchmark, and people look at these things as a sort of sign of stage of development and those sorts of things. You need to have a reasonable free float, so 20% free float, which think of that as the shares sold to incoming investors. Institutional investors usually like to see free float a little bit higher than that, but that's obviously something that the broker working on an IPO will help you with. I think the other thing is just really the reason for listing, which Ed and Shaun have touched on. Whilst you don't need to have a direct connection to the Australian market, it helps to think about exactly why you want to list on the Australian market. If there is some kind of connectivity to the Australian market, that also helps.
Hopefully that's some good tips for our viewers and they'll take that on board. We're getting quite a few questions in at the moment, and particularly it's sort of revolves around the funding landscape. So I might ask Ed this question, because I know you guys did quite a nice fundraising round not too long ago. But what's your view on sort of the funding environment over the next 6 months to a year? Do you think the ASX has been quite hot in terms of secondary capital raisings? Do you think that trend is going to continue for the next 6 months to the next year?
I think that good companies always get investment on the ASX. If you've got clear metrics that you can report on either progress or what's coming up, and people can understand that. David mentioned the market cap thing. If you are around that 150 and starting to move into the indices, then you get a much bigger base of people to go and talk to and who are interested. But there's always money for good companies, and they'll always figure you out if you're not a good company. It's a funny market. It's super efficient. So, you're not going to fake your way for too long. But if you are a genuine business and you have got genuine progress to share, then there'll always be money for companies like that on the ASX. But you don't go there because you can't get money anywhere else. You go there if you're a genuine business with momentum. Right? That's really the key thing.
Yeah, that's a very key ingredient, isn't it? Shaun, what are your thoughts on the funding landscape over the next 6 months for listed companies?
Well, interest rates, what's the RBA? 0.1%. So
close to zero, yeah.
Nothing. Let's call it nothing. So there's lots of money around looking for something to do. On the one hand, our recent capital raise was really well supported. We were oversubscribed 2.5 times inside 3 hours. However, that was what I like to think was for a really set of acquisitions that we'd made, and we've got a long track record on the market. So I think on the one hand, and to Ed's point, there's definitely money around, but it's not fool's money, right? So at the same time, you're in an environment where COVID has stripped back many businesses to reveal, some businesses that aren't what people thought, and maybe some businesses that were a little bit fickle or a little bit fragile have really been whacked by COVID. And at the same time, I think it's allowed well-run businesses to emerge, to be a really clearer option for investors. And I think what we've seen in the last 6 months is really, and I'd say it applies to listed companies, but also unlisted companies, there's a real delineation between high quality and low quality companies. So you're just not getting that grey area in the middle that perhaps are more speculative. We're finding you're getting really good companies that have weathered COVID well, that have made smart decisions and are actually using COVID opportunistically to grow. And they're the companies that can attract capital at the moment, and they're getting a lot of support. On the other hand, you've probably got a bunch of companies that are having to go to market to survive. And they're the companies that are probably going to find it really tough. Doesn't matter if interest rates are nothing. If investment funds have got tons of money, they're finding it much easier to see the good from the bad. And I think COVID has really played a role in that. So it's an interesting situation, Belinda. Lots of funds with lots of money looking for something to do. But I think this real parting of high quality versus poorer quality companies. High quality companies using this environment opportunistically to grow. Maybe there are some lower quality companies that are just in survival mode, and I think that's the category that the world has sort of found itself in at the moment.
Yeah, and I believe tech companies have weathered the storm quite well over the past year. So well done, guys. Now I just want to sort of have some concluding remarks, and might be helpful. Any tips or tricks when you were going through the IPO pathway? Any pitfalls that you guys sort of came into and sort of weathered as well, Shaun?
I don't think there are any tricks, Belinda. The reality of the IPO is you can see it as a destination or the beginning of your journey. And I think in markets where you can't list until you're, what's NASDAQ, $1 billion or something like that. So
yep.
in many countries, a listing is an outcome. I think for us and the ASX, it was very much about a launching pad for our business, you know, and it's very different. So you know, IPO, when people sit there, young entrepreneurs, and they think about IPOs, it probably appears as this really sexy, high profile kind of public display of your success. And I can tell you, it's just bloody hard work. And, you know, the other side of an IPO is you are very visible, you're very transparent, you have to report regularly, you're under the guise, as Ed mentioned earlier, of very sophisticated investors, and your progress is tracked daily, hourly, by the minute in your stock price. And that's something you've got to learn to live with. So, you know, I think it does necessitate well-run businesses by having that regulatory requirements. But at the same time, you know, it's hard work. So, you know, we saw it very much as a launch pad, not an outcome. And it's really played a pivotal role in FDV getting to where it is today.
And David, we are conscious of time, but David, I'll leave it. The last question for you: Do you sort of get similar questions on sort of what's the best way to IPO from your clients?
Yeah, look, I think the best tip is to just engage with the market early. So you know, you need to get prepared. That takes a while, but you know, getting in touch with someone like Shaun or Ed or myself, or you know, yourself, Belinda, getting introduced to investors. People, you know, the investors are seeing a lot of companies. They'll be able to give you good feedback, you know, with our help to see if it is a viable option, and then you can start planning in the background. So that it's just, yeah, preparation is everything, right? But yeah, it doesn't hurt to have an early look, yeah, and get in front of a few people and just see whether the story resonates.
Yeah, definitely true. Always to get started early. I think it's about 12 months for most companies thinking about IPOing today. Thank you so much. Look, this rounds out our panel discussion on Series B and beyond. What next? Thank you so much, guys. Thank you, Shaun. Thank you, Ed. Thank you, David, for joining me today. Thank you, viewers, for tuning in. If you want to connect with us, feel free to do so via Hubulo. We're more than happy to meet and greet and chat to you. But anyway, back to you, host, and have a great rest of the day. Thanks, guys.
Thank you.